Welcome back to AP Television. Today we're exploring a crucial topic in AP Macroeconomics, the costs of inflation. Inflation impacts everyone, but did you know it can redistribute wealth and create economic uncertainty? In this video, we'll explain how inflation can hurt savers, benefit borrowers, and even affect businesses through shoe leather costs and menu costs. Stick with us to learn the costs of inflation and how they affect individuals and the economy as a whole. Here's what we'll cover: the impact of inflation on purchasing power, costs to businesses, redistribution of wealth, and real-life examples like the 2021-2022 US inflation surge. Let's get started. First, let's look at the most direct impact of inflation: purchasing power. Inflation erodes the purchasing power of money, meaning that as prices rise, your money buys fewer goods and services. This is especially hard on people with fixed incomes, like retirees. For example, if inflation is 5% this year, something that cost $100 last year will now cost $105. Over time, this can greatly affect how much you can afford. Next, we have two key costs of inflation: shoe leather costs and menu costs. Shoe leather costs are the costs people incur when they try to avoid the effects of inflation by reducing their cash holdings. In the past, this meant people wore out their shoes by making more trips to the bank to avoid holding cash that was losing value. Today, it might mean constantly checking bank accounts or adjusting investments. Menu costs refer to the costs businesses face when changing prices frequently due to inflation. Think about a restaurant that has to print new menus every time prices rise. Over time, these costs add up and reduce profits. Inflation also redistributes wealth. When inflation is higher than expected, borrowers benefit because they repay loans with money that's worth less than when they borrowed it. But lenders lose out because the money they receive has less purchasing power. In addition, inflation can create tax distortions. People might end up paying higher taxes on nominal gains, like a raise or investment returns, that don't reflect an increase in real income. This discourages saving and investment. One of the biggest problems with inflation is that it creates uncertainty. If inflation is unpredictable, it's harder for businesses to make long-term plans. Should they invest in new equipment? Hire more workers? With inflation, the future becomes more difficult to predict, leading to less investment and slower economic growth. Let's take a real-life example: the US inflation surge of 2021-2022. During this period, inflation reached its highest level in over 40 years, with the consumer price index rising by 9.1%. This affected nearly every part of the economy, from gas prices to housing costs. People saw their purchasing power decline, and businesses faced rising input costs. At the same time, savers lost out as inflation ate away at the value of their savings, while borrowers benefited from repaying loans with devalued dollars. This is a perfect example of how inflation can cause wealth redistribution and create uncertainty. So, what have we learned? Inflation isn't just about rising prices. It affects purchasing power, creates costs for individuals and businesses, redistributes wealth, and leads to economic uncertainty. Understanding these key to analyzing inflation's full impact. Subscribe to AP Television for more lessons, and we'll see you in the next video.